All right, we're concluding now chapter 3 in the text, starting on slide number 41, which illustrates again the recording process into the general ledger. These steps are useful to follow in analyzing and then recording an accounting transaction. Note the use of T accounts to illustrate the posting process into the cash and the common stock accounts. So in this case, they're saying to follow the 3 steps: determine what type of account is involved, determine what items increased or decreased and by how much, and translate the increases and decreases into debits and credits. And that by doing that, it helps you to understand and get ingrained in your mind that, for example, asset accounts, when they increase, are debited. Liability and stockholders' equity accounts, when they're increased, are credited, and vice versa with decreases to each. Moving to slide 47, this is a follow-on to the previous chart showing the effect of the next transaction shown in the text. See that the cash general ledger account now has 2 entries on the debit side, since each transaction thus far affected cash and affected it positively. In slide 48, now we see the analysis and impact of the third transaction, the purchase of equipment. Note that this time there's a credit entry to the cash account in the postings, showing the fact that cash was reduced or credited by $5,000 to purchase the equipment. On slide 41, note for each journal entry there's been a brief explanation of what the transaction was. In this case, it was explained that the transaction involved receipt of a cash advance from a customer for a future service. Therefore, cash is debited or increased, and a liability account called unearned service revenue was credited. See how this is then shown in the postings in the accounts. Slide 50, here's the entry in postings for the service revenue received on a specific date. And notice again the continuation of the accumulation of the entries in the cash T account shown below. Moving to slide 51, note on this slide the debit to rent expense, which represents an increase to an expense account. The reason the rent expense is shown as negative in the equation analysis is that it represents a reduction in retained earnings overall, and it has a debit balance as opposed to credit balances for the stockholders' equity accounts. So it moves in the opposite way that the stockholders' equity accounts do. On slide 52, here is the entry and posting for the prepaid insurance transaction. Remember, prepaid insurance results from paying in advance for a period of coverage that normally extends beyond the current accounting period. Thus, prepaid insurance is an asset account, since the unused insurance coverage is an available resource of the company. Supplies are an asset account because they are resources available for the company to use. When they are purchased on account, cash is not immediately affected by the transaction, but instead a liability account, that is accounts payable, is credited to show the increase in liabilities from this transaction. On slide 54, note how the event is analyzed first for its economic significance. Has anything accounting-wise occurred yet? The answer is no, because the employees haven't even started to work yet. And even when they do, they won't be paid until October 26th, and that is the first event that will need to be recorded. Here's the dividends paid transaction and the impact it has on the equation and the related accounts. And we've seen this in a different format before. And now here's the illustration of the salaries paid to the recently hired employees. Note the impact of the accounts and to the accounting equation. And on slide 57, here's the chronological sequence of transactions journalized through the month. So you can see each separate journal entry for each transaction. and along with a brief explanation and where the debits and credits go. And there's the remaining transactions journalized on slide 58. Now on slide 59, here are the accounts that were posted to as a result of the transactions and associated journal entries. So the T accounts here are representing the postings to the general ledger. And the T accounts do clearly illustrate debits or left side and credits or right side entries and month-end balances of either a debit balance or a credit balance. To reiterate, the asset accounts have debit balances, as do the expense accounts. And the liability, equity, and revenue accounts have credit balances, as you can observe here. So now that all these accounting entries have been made through journal entries and then the amounts posted to the correct accounts in the general ledger, it's time at month end to prepare what's called a trial balance, so that we can see from adding up the balances in all the accounts that debits are equal to credits in total. That's a necessary step in assuring ourselves that the accounting equation, after all these transactions have been posted, remains in balance. Notice the order of presentation: the current assets, the PP&E accounts, or the non-current assets, the liabilities, the equity accounts, and then revenues and expenses. This will make it easier to prepare the financial statements later on. Moving to slide 61. Note the limitations here that relate to one of the sidebar examples in the text showing how errors can occur and not be detected in the trial balance because it still balances. See page 109 for the vignette on why accuracy matters and discussion question response on page 158. So these are all examples of where the trial balance could balance even though any of these errors may have occurred. So on slide 62, moving to a review question, the trial balance won't balance if, and C is the correct answer because we have differing amounts being debited and credited. The actual transaction was a $100 cash dividend. It's debited properly to dividends account, but the amount recorded is improper in that it's 1,000 versus 100. The credit to cash for 100 is correct, but obviously there's a $900 difference there between the amount debited and the amount credited, throwing the accounting equation out of balance. And you can't do that and still have a situation without an error. So hopefully everyone sees that A will have no effect on the balancing of the trial balance. B is an incorrect entry, but the proper credit to accounts payable liability has the same effect on the equation, increasing liability, as the incorrect credit to cash has in decreasing an asset. Answer D will also not cause the trial balance to be out of balance just because it's incorrect, because it's equally incorrect on both sides of the entry. Moving to slide 63, we've got a whole series of information here about IFRS, the International Financial Reporting Standards. Remember, I won't be asking IFRS questions on a quiz or exam, or if I do, there will be very few of them, and I will warn you about what you need to know. So we're going to kind of gloss over these next few slides. I'd encourage you to learn more about it by participating in the extra credit opportunity, which is 5 points possible for writing a short paper about the current status of IFRS implementation in the United States and where that's going. And this is just saying that a trial balance under IFRS follows the same format as shown in the textbook. Dollar signs are typically used only in the trial balance and financial statements. The same practice followed under IFRS using the currency of the country that the reporting company is headquartered at. Slide 65, more IFRS. Some of the issues the SEC said should be considered are whether IFRS is sufficiently developed and consistent in application, whether the International Accounting Standards Board is sufficiently independent, and whether IFRS is established for the benefit of investors. So there's a lot of things that are going on in looking at whether the IFRS should be adopted worldwide, including the U.S. And this one goes on to look at some of the issues the SEC said should be considered. I'm not going to belabor this. You can read that for yourself. And looking into the future, and again, this text is circa around 2008 or so, so things have been happening obviously since then. The point is that the recording of the process shown in the text is followed by companies across the globe, and it's unlikely to change in the future. The structure of assets, liabilities, equity, revenues, and expenses may change over time as the IASB and the FASB, the U.S. board, evaluate their overall conceptual framework for establishing accounting standards. So which statement is correct here? B is correct because IFRS uses the same process for recording transactions as GAAP. IFRS certainly doesn't reverse the rules of debits and credits. Chart of accounts is not different because revenues follow assets. So B is the correct answer there. Trial balance is the same under IFRS and GAAP. And finally, IFRS uses more fair value measurements than GAAP, and I think we've alluded to that before. So with that, that concludes part 3 of the Chapter 3 presentation.